Hello, everyone. Welcome to Income Investors. My name is John Whitefoot, and with me today is Mo Zulfiqar with a quick economic update. Now, our goal with these videos is not to tell you what to buy or sell, but rather inform you with what's happening. And if you want to read more about what Income Investors is all about, head to incomeinvestors.com. You can find the link to the website in the description below. So, without further ado, Mo, what have you got for us today?
John, today I want to talk about the stock market as a whole today. You see, soaring stock market is great, and I personally love it when everyone is making money, but it's important to keep fundamentals in check. Here's the thing. In the short term, the stock market moves on noise and emotions and what have you. But in the long term, valuations really matter. The higher the valuations, the more cautious one must be. If you look back in history, you'll find that whenever stock market has seen valuations stretched, a decent sized sell-off has followed. As it stands, the stock market is getting expensive. But before I go into any details, I want to make it very clear that I'm not saying to sell everything and sit on the sidelines, or a stock market crash could happen tomorrow. All I'm trying to do is educate a little bit.
Okay, so with that said, what do you see?
I am looking at three valuations measures very closely, and they suggest, again, as I said, the stock market is getting very expensive.
Okay, and what are these measures?
John, the first valuation measure I'm looking at is the forward 12 months price to earnings ratio. One way to look at valuation is to see how much investors are willing to pay for future earnings, hence the forward 12 months price to earnings ratio. Currently, the PE ratio for S&P 500 companies is set at 20.6. And mind you, the number by itself doesn't really mean anything. You have to see how it is doing compared to historical averages. And this is where the problem comes in. The ratio, which is at 20.6 now, stands above its 5-year average, which is around 19.1, and its 10-year average, which is around 17.8. And that's a little scary.
Yeah, that's totally entirely frothy. And what's the second valuation measure?
The second valuation measure is called the CAPE ratio, and this is the PE ratio adjusted for inflation and business cycle. If you were to put in simple word, it's a better stock market valuation measure than just, your plain vanilla PE ratio. Currently, the CAPE ratio stands around 33.42, and again, you got to compare it with historical averages, and turns out it is 100% above its historical average, and it has been persistently around this level for a while. And here's the kicker. The last time CAPE ratio was this high was during the tech bubble of 2000s.
Well, we know that things didn't turn out so well for stock market back then. Now let's round it out with the third one.
There's this ratio called the total market capitalization to gross domestic product ratio. This ratio essentially looks at the size of the stock market relative to the size of the economy. And mind you, this indicator is also closely followed by Warren Buffett, the legendary investor. And some may even refer to this indicator as the Buffett indicator. And how do you read this indicator? If it's over 115%, it means that the stock market is overvalued. And again, here's a scary part. At the time of this recording, the total market capitalization to GDP ratio stands at 180.7%. To say the least, this ratio is saying that the stock market is significantly overvalued. And looking at this, it also makes a lot of sense why Warren Buffett, Berkshire Hathaway, has been accumulating so much cash.
So what do you make of all of this together?
The three valuation measures I pointed out are really pointing a dire outlook for the stock market, and one has to wonder how long this bull market could last. Could we get a robust sell-off in 2024? I don't know, but here's what I know. The stock market sell-offs are a common thing. They do happen often, but worse is when somebody gets caught in it. And if you know what is happening, you could, save yourself from it. Also, stock market sell-offs are great in a sense that they create opportunities. I have learned over time that in times of panic, investors sell everything and anything in sight. So you get some great companies selling for deep discounts. And in case we see selling on the stock market in 2024, it could be a blessing in disguise for dividend investors as well. They could buy some great companies that we profile here on regular basis at low prices.
That's great. And thanks, Mo, once again for your valuable insights. If you want to check out what Income Investors is all about, you can find the link to our website in the description below. While you're there, you can sign up for our free special report on 3 income stocks to own today. One of those stocks currently has a dividend yield of 12.7%. We'll be back with the income pick soon, so stay tuned and don't forget to like the video and subscribe to our channel. Goodbye for now.